Hello, good morning, good afternoon, good evening. Welcome back to another episode of the Money Multiplier podcast. Just like the last few episodes, I've got the unique pleasure of hosting with my good friend and colleague, Hannah Kesler. Hannah, what's going on?
Hey, Jonah, how are you doing today?
I am doing well. Thank you for having me on the show again. I'm excited to talk through some of the infinite banking topics that we've seen over the last week, over the last days that people have asked us. And man, I think it's really unique that we get to do the podcast together because we've got a unique experience to talk to so many people that actually come through the doors of the Money Multiplier, right? Because you're going to talk to them, whether that's upfront in person as kind of the first contact at one of the events or during the application process. And then I've got the unique pleasure of speaking with them after they get started and kind of helping them use their policies as they get going. And so that makes it really cool, kind of a unique pairing here so we can give some of our insight and knowledge to the folks out there who are interested in listening.
That's right. I call it the full circle or the full
Yep,
circle, the
there it
full
is.
package here from front to end.
I like that. That is very, very cool. Well, we've got a very interesting topic today. I like this topic because there is a time or two where I get on the line with someone who's very interested in getting started and they ask this question. And so I'm excited to actually kind of walk through some of the answers because when they ask this question of me, sometimes I get a little taken back because personally, I don't believe that I've really got an answer for them. And I can try to feed them an answer that maybe they want to hear, but a lot of times when they ask this question, they're looking for maybe a specific answer, right? And so
Mhm.
we're going to dive into that topic today and answer some of those frequently asked questions. So, Hannah, if you want to jump in, tell us your take on the topic, and of course, what today's topic is.
Yeah, so we're going to talk about the cons to the infinite banking concept. We get this. I sometimes actually I do get this question when I am on the phone talking with folks, and I like the question honestly because it really gets me to think. Because right at the end of the day, there's no silver bullet out there for everybody. But in my humble opinion, I think everybody who stands in front of a mirror that can fog up the glass, everybody should be practicing infinite banking. But I like this question. It's good and it has a new take on it. So, and really, what sparked this topic too is because I received an email one time, and this gentleman he was asking about. He says, "Hey, I read your book, Mapping Out the Millionaire Mystery." And you can go, Mapping Out the Millionaire Mystery was written by my dad, Brent Kesler, and our colleague, Chris Noggle. And he was going on to say, but in today's markets and life insurance companies are different than what they were before COVID. Who is willing to pay more than 3% on the assets in whole life policies? I hear it's only a 1 to 2% max. That's not worth it. So it was really interesting. I really liked his take on it, and we had a good phone call and a good chat on it. And that's what really sparked the topic of, hey, well, what are the cons to infinite banking? I guess my first take on it, when he did mention that, hey, COVID has changed the times of the industry. In my opinion, no, it did not, right? Because infinite banking, this whole platform and this concept, it's been around since 200 plus years. It's
That's
even been
right.
around longer than our tax code. The tax code's only been here since 1913. So no, there's no changes or difference of what's going on. Here's my other con, that some folks will say, they're lower returns, right? You don't get high returns inside of your whole life infinite banking policy that's designed for this infinite banking concept. But at the end of the day, what does Nelson Nash say in his book, Becoming Your Own Banker? This process, this concept is not about the rates of return. I mean, he says it right in the introductory page on page 3 or 4 or something. So what are your
That's right.
thoughts, Jonah?
That's right. I thought it would be really cool to maybe walk through some of the things that we've heard folks say to us and the answers that we would give or the explanations that we would give them. So I think we made a list before the episode started. I'm going to jump into the first one if that's okay. So
Hmm.
again, sometimes when folks ask this question of us, whether it's over the phone to us, Zoom calls, in person, they say, what are the cons of infinite banking or what's the downside? Because we like to talk about all the benefits, all the new things you can do, accomplish, finance in your lifestyle using this process. And sometimes if you spend 10 minutes, 20 minutes, 30 minutes, or an hour talking about all the positive things, somebody somewhere is going to say, well, where are the negative things, right? And so
Mhm.
I have heard this statement before. Well, if I do an infinite banking policy, it takes too long to build up. It takes too long. I want to finance a car, a house, a rental property right away. I saw those in the examples that you guys were using. But when I started my policy, I can't do that right away. Right.
Mhm.
And so they say,
Mhm.
well, that's not what I want to do. Maybe I should just use my own money to go do that stuff instead of using the infinite banking process. That is a statement or a con that I have heard from infinite banking. Now, I've got an answer for him that I'm definitely going to jump into, and I'm wondering if you have anything to say on that topic.
I guess the first thing that comes to my mind is that if they're saying that, they're not working with the right people. Right? Right? Because the fun thing about these policies is that you can design these things for any which way. Some folks, they need that higher liquidity. Hey, I need the cash out right now, 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 because I'm just in this financial hamster wheel and I need to get out of all of this debt, or I have this big opportunity that I need this cash for. So that's my first thing. But what really the foundation of the answer to that question is that they're not thinking long range, right? I'm okay that in the early years to give up a few dollars to protect my family, to protect my assets, and at the same time, right, I'm still able to leverage the policy to go out, do X, Y, and Z with it. But really, it doesn't take a long time to build up, because if you are actively using this process and this concept, the larger the values are even going to be within inside of the policy. I go back to Nelson's example when he talks about the equipment financing and showing the differences. Hey, if I use the policy to finance one truck all the way down to four trucks, where am I at in the long haul? So I think people are thinking about it differently, and they're not understanding the whole ideology about why we want to funnel dollars through the policy first. Number one, never losing the opportunity cost. Number two, the control of it. And then number three, the certainty and the protection that it also gives us. So that's my opinion on it.
I love that answer. So here's one of the things that I tell folks a lot. Like, let's be real for a second here, okay? So if I start a policy, even the biggest policy I could possibly get my hands on, the dollars I have in my pocket I could get my hands on. So let's call it a huge one, $50,000 a year, $100,000 a year plus into a policy. And then I get on the phone with someone ready to help me and say, well, I want to buy my own private island and I can't do it yet, right? Well,
Yep.
what's the answer to that? Well, two things. One, it's because private islands are really expensive and we didn't put all that money in the policy yet. Or two, it's because you've got to let your policy build and let it grow. Cash value builds and grows throughout the year. So sometimes when I hear that con, I take a look at the policy premiums and I see, oh, okay, $1,000 a month. That's awesome. It's a great place to start. But you're complaining about not being able to finance your house purchase yet when you live in a $500,000 home. Does that make sense? So
Hmm.
sometimes it's like it can be a con if said in the right context, but at the same time, sometimes when we get that question, it's almost like, well, two things: can we work? Can we work to build it up at all? Are you going to give it a chance here to let the cash values grow? And at the same time, too, like let's be realistic about what we can accomplish with the dollars that you've gotten into the policy so far. So I just wanted to bring that up.
And one thing too that I'm kind of thinking about, one question that I do get, and this kind of comes from a lot of my real estate investors, that they'll come to me and they'll say, Hannah, I got $100,000 inside of my policy, but this property that I want to go buy is 150,000. Should I even use the policy at all? And it's like, ding, ding, ding. Yes, you should, right? Because it's okay to finance some of the purchase with the policy instead of none of it at all. I actually, in my own life, a few episodes back, Jonah, we were talking about my conversion van. I didn't have enough dollars inside of the policy to finance that thing 100%. I had maybe 85% of the cash, but that's okay. I used that 85% and then I just went and outsourced that other 15%. And then you know what I'm doing? I'm using my policy to pay off that other 15%, that loan that I got on it. So,
That's exactly right. I love that. I love that example. Okay, we've got some more cons that we want to talk about. Hannah, I think I'm going to let you take this one. What about if someone says, and a very popular person has said this on the airwaves, it got a lot of traction, I have to pay interest on my money? Why would I do
mhm,
that? What are your
mhm.
thoughts?
Yeah, I know this one's a good one. This one gets me going. So really, when folks are saying that, they don't understand what's going on. They're not understanding what's going on underneath the hood. Because no, when we're taking dollars out of the policy, we're not borrowing from our cash bucket that's physically sitting within inside of the policy. We're putting that policy up for collateral, and we're taking a loan from the general funds of the insurance company. And let me even go deeper into that. We need to do a better job, in my opinion, on touching on this. But inside of the policy, our dollars are growing and compounding, uninterrupted compound interest, while we're taking loans out from the insurance company at a simple interest. So that's very powerful too. But
It
but but
is.
really, why we're taking loans and not physically withdrawing the money out is because when we're taking loans and borrowing from the general funds, we're never interrupting that compounding on the cash inside of the policy.
That's absolutely right. Over on our channel, the Banking Bros, we like to use cups. We actually have something called a 3-cup setup. And the reason we use cups really is because to illustrate that if you put your deposit dollars, your premium dollars inside of cup one, and the insurance company puts dollars inside of cup two, cash value that you can use, and you decide to reach your hand in that second cup, take all that money out and spend it, it's a good way to illustrate that cup one never was impacted. You didn't put your hand there and reach in and take anything out and spend it all. And that's why we like to illustrate with just understanding that cash value is a completely different pool of money than your deposited dollars. It's just
Hmm.
separate. So if someone says I have to pay interest on my money, the answer actually is no, you don't. You're not actually understanding, like Hannah said, what's going on under the hood. It's not your money that you're taking out. That is a benefit. That is a huge benefit. You put in your dollars just to take out your dollars. Well, who in the world's going to pay you interest on that, right? You got to
Hmm.
let it sit traditionally. Here, we're going to use the insurance company's money. It's liquid every step of the way. I love that. I love that. Okay, cool. I think I've got one that folks have said once or twice. They say, Jonah, whole life insurance is too expensive.
Yep.
There's a very popular phrase out there that goes buy term and invest the difference, right? And the
Hmm.
reason that phrase is popular is because term insurance is less expensive. So let's dive into this for just a second. Can we again, I just want to explain, but I want to be real with you. I don't want to sugarcoat anything. Someone says buy term and invest the difference or whole life is too expensive. They're comparing the two. Would you agree?
Yes.
If I said apples are more expensive than oranges, I'm comparing them as far as, listen, it's just a fruit I'm going to eat and one's more expensive than the other, right?
Hmm.
That's what I'm comparing. But let's jump into what they're comparing for a second. Term insurance. Buy term, invest the difference. Whole life is more expensive than term. Term insurance offers you putting money into that plan or program and the insurance company paying a death benefit when you pass away. That is the complete and total definition of term. There's not any other avenues or aspects that we can jump into. Generally, you can have a term for 10, 20, 30 years, but that is term insurance.
I call it renting insurance. I
It
think that's
is.
the easiest way to explain it. You're renting the insurance for that set term, 10 years, 20 years, 30 years, whatever it may be. And you're not building up any equity. Just like the difference between buying a house versus renting a house, you're not building up any equity because all you're doing is just renting it.
That's exactly correct. So, when we talk about whole life insurance, the other comparison in this equation, well, whole life insurance has another avenue, another branch, and it's cash value. Term insurance doesn't touch on this, doesn't have anything to do with this, where whole life has cash value. So, my question for you is if we're comparing something that has a death benefit versus something that has cash value and a death benefit, it does not seem fair to say one is more expensive than the other. Well, one
Agreed.
comes with more things. Who would, in their right mind, walk into Best Buy, and say, oh my goodness, the HD TV, LG, all the bells and whistles is more expensive than this other one. Well, does the other one have all of that stuff? No? Okay, then. Well, we know why it's more expensive then, right? I mean, doesn't that make sense? It's just so funny to me how someone as popular as some of these radio hosts and celebrities can sit there and say, oh, well, it's more expensive. Buy term, invest the difference. All you need to compare is price. When it's like, come on, come on. You've got to know that there's more going on inside of whole life than there is term life. And if there's more going on, of course it's more expensive. Now, it is more expensive, so I wanted to touch on that, but I also want to touch on the way that we design these policies. See, when you get started with an infinite banking policy with us here at the Money Multiplier, you get to choose your premium. You get to choose, you get to pick it. Hannah, we've seen premiums all over the place, right? I think
Mm-hmm.
I've seen premiums as low as, $100 a month or so, maybe if they're insuring their children or something like that. I've seen premiums that are way big, 6 figures, 7 figures before, right? You get to pick that. When I started my very first policy, it was $5,000 all year. That's what I had. That's what I could afford. That's what I put in. And I started more since then that are higher, but I picked it, right? And so for me to say, well, whole life's too expensive when I'm the one picking the premium, that doesn't make a lot of sense to me either, right?
Yeah, good.
You can start with what makes sense for you and your family.
Good. And I want to dive in deeper too, because I think why folks touch on it as it's too expensive is because they are looking at it in the traditional view of the quote unquote cost of the insurance. So let's just kind of touch on that for some of the analyticals that are listening to this. When we're talking about whole life versus term, right? You kind of just back to my example of renting insurance versus buying insurance, right? Renting the house versus buying the house, where in whole life you're building up the equity inside of the house. So with term, what people don't understand, and this is why I get a little frustrated, just like how you said, Jonah, just with the gurus that are out there who are so big, is that they don't touch on, well, hey, once my term is up, let's say I get this policy and I'm 30 years old and I have a 30-year term policy. Once I am 60 years old, that term is up. So what has to happen now? I have to go back in at 30 years later at 60 years old and go buy another term policy if I want that coverage on myself for my family. So at that time, now I'm 30 years older, I'm 60, I may have some health challenges going on, and because I'm older, the cost of that insurance is a lot higher now too. So what some folks don't understand is that in whole life, it's built in. It literally says it in the name. It's whole life. The insurance company understands that they're going to have to pay out this death claim at the end of your lifetime. And so I kind of use the other analogy of like how term, you're kind of betting against the insurance company where you're saying, no, 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 insurance company, I for sure will die within this term. How fun is that when I say it like that, right? Whereas whole life, you're betting with the insurance company. You guys are kind of going on this lovely parallel track together. So that's all I wanted to say.
I love that. Have you ever run into someone, Hannah, where their term ended, they're 50, 55, 60, 65, and their term insurance was up? Have you ever talked to someone like that and asked them about how much getting term insurance again at 50, 55, or 60 costs? Because I had this happen to me recently, and I was baffled. I'm not
Mm-hmm.
joking, by the cost of term insurance for I think the gentleman was 55 years old. It was ridiculous. I'd
Yeah.
never seen something like this. It was over $2,000 a month for the term insurance again. Because of course, if you get term insurance at that age, the insurance company's saying, well, we know you're going this time, right?
Yep.
And against, just like you said. So, okay, I love that. I love that for bringing it up. Very cool. Well, Hannah, so here's the fun part. We've got a few more cons that we want to walk through, but maybe we should do a part two, right?
Okay.
Come
Yeah, we
back,
can do
come
part
back on the
two.
next episode for part two, as we walk through some more cons. But before we head out, I actually wanted to give a shout out to all of the members of the Money Multiplier who are doing a live event or speaking somewhere in the next upcoming week. So that way, if you're in this town or close to the city and you want to go hear us live and in person, invite a friend, invite a family member, you surely can. So Hannah, I think you're in Arizona in the end of July, about 1 month away. Is that right?
That's right. So July 28th, the town is called Gilbert. It's right outside Phoenix. So Gilbert, Arizona, 1-day event, July 28th. I'll be there. Y'all just call, email, text me. My email is hannah@themoneymultiplier.com if you want to learn how to join. And then immediately following that one, the next day, July 29th and 30th, Pops and I, we're going to go up to Buffalo, New York, where Chris has a 2-day live event. And with that one, you just go to moneyschoolrei.com/July, and we'll link it down below as well. But tickets are going, so 30 days out.
I love that. So that's July 28th in Arizona. That's July 29th and 30th in Buffalo, New York. A little bit closer in the next upcoming weeks on July 5th, one of our colleagues, Jesse Durham, is doing a live presentation. That is in North Carolina. I believe it is in Durham, North Carolina. And on July 9th, the Banking Brothers, which is myself and my brother Jeremiah Do, we're going to be in Greenville, South Carolina. And that is another live speaking event. And again, that is July 9th. If you need any details on the South Carolina or North Carolina event, you can email myself. That is Jonah, Jonah, at themoneymultiplier.com, and I'll be able to get you those details. Thank you guys so much for joining us on another episode of the Money Multiplier podcast. We love you. We'll talk to you next time, and have a great day.
See you then.